Hi there. Welcome to Know Your Options every 2 weeks on Wednesday at 3 p.m. Eastern Time. Excuse me, I'm clearing my throat. I'm talking to our host, Chris Tom. We dive deep into the world of options trading. We explore the fundamentals of puts and calls and how you can effectively incorporate options as an investing tool to maximize your returns and manage risk. You can call toll-free 1-855-326-6266 or email us knowyouroptions@bnnbloomberg.ca. Chris Tom joins us every week on Know Your Options. He's CEO and Portfolio Manager at Moat Financial. This is great to have you. Last week we talked about, or 2 weeks ago, we talked about leaps, the long-term options, but there's a trend in the industry now going to shorter and shorter terms. And there's going to be, in some cases now in the States, expiries 3 times a week. Can you talk to us about that?
Yeah, for sure. So I mean, if you look out through the history of options, there's been all longer dated options that have just been getting shorter and shorter and more frequent over the course of time. So last show, obviously, we talked about leaps, which is anything over a year. On S&P 500 options, there are dailies. There are options that expire every single day. But now on the single equity options, so looking at specific stocks, or starting with the Mag 7 because they've got the best liquidity, yeah, you can buy or sell options that expire on Monday, Wednesday, or Friday, going out a few weeks. So you can really pinpoint the time frame that you want exposure to. And
what's the shortest term that's available on single stocks now?
So as of now, this started trading a few weeks ago on these names on the Mag 7, it's Monday, Wednesday, Friday.
Oh, what do you mean? Sorry. When would I buy an option that expires on Monday?
So they start trading about 4 weeks before expiry. Okay. So you could pinpoint basically any date over the next month. You can say, okay, I'd like an option that expires on the Monday, Wednesday, or Friday. On many other less liquid names, so this is sort of the test case for them with the Mag 7. There's many other stocks that do trade weekly. Now, those are available in Canada and the U.S., whereas these Monday, Wednesday, Friday ones, those are starting in just the U.S. And then, if we go back to the less liquid names, a lot of them, it's just the third Friday of most months.
The traditional expiry.
Yeah.
Yeah. I just want to make sure I have this right, and I'm sorry. So let's take a very liquid stock like Apple. These Monday, Wednesday, Friday expirations. So how does that work? When would I buy one of these options?
Yeah, so let's just say a lot of times these are going to be pinpointing around an event. So let's say earnings. Typically, if you had a less liquid name that was, say, reporting on the 5th of the month, you might have to, and you wanted to have an option that gave you some exposure, you'd have to sell something that's, say, around the 20th, or buy something that expired about 15 days later. So you don't know what's going to happen in those days, and you're not focused on that. So for this, if you said, okay, Apple reports on Tuesday, I want to sell a covered call, you could go out a few weeks and sell it so it expires on the Wednesday. So that would expire at the end of the day on Wednesday based on where it closes that business day. All the expiry piece and, in the money, out of the money, automatically exercised, all that stuff, that's all the same, still 100 shares per contract. But really, it's trying to pinpoint it around events. I think a really big one you'll see a lot of activity here will be around interest rate announcements. So that's one where typically those, Bank of Canada or the Fed, it's, Tuesday or Wednesday. But if you wanted to have something really short dated to play that event, it always had to be a Friday. Well, something crazy might happen on Thursday or Friday that you don't want that. So now you can really just laser in on when you want these things to expire.
When you talk about Fed or Bank of Canada, are you talking about interest rate futures or equity options?
We talk about, the biggest thing that makes up pricing in options is always volatility. If there's more volatility or more uncertainty, then you see option prices go up. So when we don't know if the Fed is going to cut rates or raise rates or what they're going to do, that makes the price of equity options really go up. Because you can see all of a sudden if the market's expecting rates to be flat and then they cut 25 basis points, it's likely that you might see a big rally in the market. So people will pay more for those options on these days that have this bigger uncertainty where there could be an event that moves the market.
But we're just talking about equity options here. We're not talking about fixed income options or anything like that.
No, not yet. So, I mean, the thing with these different option listings is, the markets. So in the States, CBOE, they've got huge liquidity. They try new things. And it's basically, if people will buy them, if people will trade them, then they will create them and they will list them. So over the years, they've brought on these new products, and most of them have been successful. The only one I've ever seen that wasn't was they did these mini contracts. So on a lot of the really high price stocks, before Apple had split and Tesla before it split 7-1. Every contract normally is 100 shares. So 100 shares of a $500 stock, well, that's a big position. So they had created these minis where they were only 10 shares per contract.
Right.
So I think they wanted to, give more exposure to more people. But what they found was that the liquidity just wasn't there. Because as soon as you're going to trade more than 10, you just go up to the regular contract.
Yeah.
So that was something that they tried. They traded for a little while, and eventually they got rid of them. So I would bet, if I could somehow, that these will be successful and people will trade them. The risk is that it cannibalizes other lines. So, if all of a sudden people are trading the Wednesday one instead of what they would have normally traded on a Friday, then you might see liquidity, not as good for both. But you're just seeing so much growth in all this option trading that, I would say this will be a winner.
What about the option sellers? It's a new source of income for them.
Yeah, and if you want to say, okay, so we talked about the options that expire every day. So there's an ETF, a couple of them in Canada, that sell calls every day on the S&P 500.
Oh, well, that's been around for a while.
It's been around for about 6 months. So every day they sell them, and they sell them in the morning, they expire at the end of the day.
And they try to pocket the income.
Exactly.
Yeah.
And so I think you'll probably see some ETFs that come out in the near term here that are selling, 3 times a week, these calls on single names. If the people will buy it, the companies will create it, and I bet you'll see it.
Okay, but the options the ETFs have been around for a while that give you the daily move in a commodity or even a stock. They use a different mechanism.
So the one that I was talking about was selling covered calls, where they sell it every day. They have a basket of the S&P 500, and on a piece of it, they sell a call every day. Like I said, the market just wants income. So on these income-producing ETFs, if you can produce income or have a different way of setting it up, then people seem to be all over it.
You and I were talking before the show, though, about how in some ways this is getting close to gambling, these one-day options.
Yeah, if you're a buyer of these and, if you buy this option and you say, okay, I think the Fed's going to cut rates, so Apple will go up between now and 3 hours from now, and it doesn't. Well, you lose all your money, right?
Yeah.
So whatever you put into that option, it goes all the way to zero, and it isn't coming back. So there's definitely certain people who use options for the riskiest ways. As you know, we're always on the other side of that, being the seller, to just try to get a little bit more income. But if you use them wrong, they can be wild.
Do you hear horror stories of people losing a lot, retail people losing a lot on options?
I honestly, surprisingly, haven't heard a ton over the years. I don't know if people bottle those up and you never hear from them again. I have heard stories about guys trading in the VIX pit in Chicago, and they have a bad day, and you just never see them again. You hear they're selling cars in California after that or something like that. But otherwise, no, not really. I think where people can definitely make expensive mistakes is doing the math wrong and forgetting that each contract is 100 shares. So you make a commitment, you say, okay, I've got 1,000 shares of something, I want to sell calls against it, and then you sell 1,000 calls. Well, you've sold 100 times too many, so it can be a little bit tricky at that point.
That's interesting. You find you got just leverage on far more money than you thought.
So you got to it's why we always say check your math at the start and triple check it by the end.
Oh my gosh. Okay. Up next, we're taking your calls and emails for Chris Tom. We want to hear your options questions, 1-855-326-6266, or emails at knowyouroptions@bnnbloomberg.ca. Let's kick off here with an email from Greg. Greg says, listening to your comments on NextGen, the would-be uranium miner, what are your thoughts on using a synthetic position instead of buying it? And can you explain the question first, Chris, please?
Yeah, so appreciate that question. Really, a synthetic position is where you, instead of buying the stock, you sell a put and buy a call. Okay, so these things are something that I think we've talked about on another show where we don't really use it very often because it doesn't really do much for you, right? It gives you the same upside as if you own the stock and the same downside, but you've got to do multiple trades and you might be dealing with multiple, spreads because, you've got to sell that put and use that money to buy the call. So for us, we don't typically do it. The only time that we'll ever do it is if we're wanting to get exposure to something and we're just not wanting to sell a stock. Maybe, we've got a big piece of the portfolio is, in one stock that's got a huge capital gain. Mm-hmm. And it's like, okay, in order to buy another stock, we'd actually have to sell some of this in order to gain that exposure. So in some cases, you will set up one of these synthetic positions. But you got to realize with a lot of these options, trades, and different strategies is you end up in the same position, right? A lot of times if you sell an in-the-money call, it's the same payoff and same outcome mathematically as if you had just sold a put. There is no free lunch on a lot of these things because if there was, obviously you'd have hedge funds and algorithms and computers that just swoop in and then wipe away anything there. So I guess the short answer is if you have the cash and you want the exposure, I would just buy the stock. NextGen does have really expensive options. It's a big few days for them with their final hearing to whether or not the Rook project will move forward. So for us, we have just sold a put because the options are expensive, and we'll take the exposure if the stock goes down. But at this point, we'll take that premium.
What's the strike on the put you sold? Do you remember offhand?
13 and 12. So we've sold a couple, based on timing of when money has come in. But here we are. The stock is 16 bucks.
Yeah.
But the implied volatility on this has just gone wild. They report on the 20th, and they've got this hearing. So if the government says, "Hey, yes, your mine can go ahead," or cannot, well, that's going to move the stock for sure.
We'll keep an eye on that one. And you're happy to own this stock, in other words, at 13 or 12.
Yeah. I mean, that's why we picked those levels. I mean, I guess if it goes to $10, then we won't be as happy as we thought we might be. But You know what? We've been selling puts on this for quite a while, and it's the repetitive nature that you're doing it over and over and over. If you're bringing in, 50 cents every couple of months, well, if you've been doing it for a while, then you're not going to have, a huge penalty box experience. So yeah.
That's interesting. But they are high-priced options because of volatility in the shares.
Very expensive. The shares have been volatile, but more than anything, there's a decision coming, right? If the government says, hey, you are good to go, well, that makes these shares likely more valuable.
Yeah.
And if they say, hey, no, or there's going to be some delays or some costs, or you need to get these agreements, like whatever, that slows things down, then that could hurt the stock. And so because we don't know what the answer is going to be, obviously the share price has gone up. So I think most investors think the answer is going to be yes. But if there's a hiccup, that will move the needle. And so what you'll see is the options after the announcements will become much less expensive. So options that you're selling today, while there is that uncertainty, they have that. But going forward, if the stock rallies, everything's hunky-dory, then they won't be as expensive selling them in the future.
And so somebody looking at it and thinking, well, I'll get a cheap play on NextGen by buying a call option, you're going to be paying a pretty fat premium. Yeah,
for sure. We looked the other day at buying some 18s, and it was just like you needed the stock to go to like $20 to break even. And so for us, that's why I say let's not mess around. Either sell a put, capture that premium, or just buy the stock and see what happens.
Right. Okay, we have an email from Eric. Hello, I was wondering how I can go about purchasing a stock at a put option without letting the time run out. Can I do it earlier than the expiry date? Can you explain that question as well?
Yeah, so it sounds like he's sold a put and the stock might have gone down, he wants to take delivery. So if you have sold that put, you have no rights. Right, you got paid money to give someone else the right to sell you that stock anytime up to that expiry. So if they decide a week early, a month early, hey, I want you to own this, they can make that decision.
At any time. They don't have to wait till expiry. No, of course, that's the idea.
Equity options are called American-style options. So some of the index options are European-style, which are only exercisable on the last day.
Sure.
So a little lesson here for the day. But equity options are American style, which is any time up to expiry. So the person who's bought that option, that put, they can put it to you whenever they want. But you can't say, hey, let's exercise this early, the stock's gone down. So if you want that stock early, you're going to need to buy back the put and then just buy the stock. So you've got to do it in two parts. If you've sold someone a put, you don't have the right to exercise that option.
Yeah.
But you do have the right to buy it back anytime you want, right? You just go to the market and there's a bid and an ask for it, and you close out your position. And then if you want that stock, you buy it. So you can't exercise the option, but you can effectively do the same thing by buying back your put and buying the stock.
I can't quite. Sorry, what was that? What was that last thing you said? You go into the market and buy the stock.
You would buy the stock. This guy he's sold a put.
Yeah.
And wants to exercise it early, but you can't. But you can get the same outcome by you buy back the put that you sold. So
you buy back the put, yeah.
And then you just buy the stock. And so now you own the stock and you're not short the put anymore.
Right. And say I'm the holder of the option, though.
Yeah.
I bought it and I exercise. I obviously don't phone you. I don't contact you directly.
Right.
How do I exercise?
You call your broker, and your broker calls the exchange and says, hey, we want to exercise this. And then it's all done. And the next day it comes out of your account based on the previous day. So that's why we see it around dividends. So let's just say I own the stock and I've bought a put to protect my position. I wait till that dividend comes. I get paid when it goes ex-dividend. And then I say, okay, well, thank you for that. Now you can own the stock. And it doesn't pay a dividend for 3 more months, but I'm out type thing.
And the seller of the put will get a call saying, hey, you got to put up this cash to buy the stock.
That's right. You get an email in the morning saying option assignment, you now own this stock. So, because it's as of the day before, now you've got to come up with that cash today. It's T plus 0.
Yeah.
You always, that's why when we're doing this, you always have to watch the ex-dividend dates. I think that's part of why these ETFs have grown so much.
Sure.
Because you just buy them and you don't have to worry about it. You've got a manager who is taking care of that and watching these dates and all that. I mean, that's I think that's a big part of it.
Okay, we'll squeeze in a question. Hey, Chris, congratulations on your Moat ETF. That's your new ETF. I'm a unit holder. I followed your top pick, PGR. I forget what stock that was.
Progressive.
The insurance company. February 2026 held puts at 215. The share price was 230. Today, PGR is about 201, which is below the strike of 215. I'm not opposed to receiving the shares and selling a call. How would you handle this position?
So for this one, you must have sent this in yesterday because the stock is about 208.
Oh, okay.
So you sold at 215. Stock is 208. You could buy back that put for about $7 or $8, sell something further in the future. But yeah, if you want to take delivery, if the stock stays here over the next week and a bit, then you will own that stock at 350 or 215 minus what you sold the option for. Mm-hmm. And then, you can turn around and sell some calls for sure.
We don't have a chart for Moat. You launched it there in mid-January. And just tell us very quickly, if you would, how it's supposed to work, that ETF. Yeah,
so in that ETF, the bulk of what we're doing is selling cash-covered puts. So there's cash in there, and then we sell puts to acquire stocks at lower prices or generate premium. But the beauty is that it's got embedded downside protection. So, the market doesn't have to go up for us to make money. It can stay flat, or it can even go down a little bit over the course of time, and we'll still make money.
Let's squeeze in a caller. Sebastian, thanks very much. You've been very patient in Calgary. Go ahead, please.
Thank you, Andy. Thanks, Chris. Excellent show. Please keep it up. Chris, my question is on the straddle. When would I use a straddle? Is that, when I'm looking to buy the underlying or if I'm trying for protection? Could you explain that and when would I use a straddle? Thank you very much.
And give us a quick definition of a straddle, please, Chris.
So a straddle, let's say, obviously you can buy or you can sell it, but we'll talk about buying a straddle. That's where you buy the put and the call at the same strike over the same timeline. And so you need the stock to either go up or down by more than what you paid for those options. So
you want to swing one way or another.
Yeah, you don't care. The put and the call are going to have a little battle, and you don't care who wins as long as it's by a lot, right? And so a good example of this, I think we were talking at the break about McDonald's is reporting today.
Okay. So
if you can look out to buy the straddle, the 320 straddle, that goes out, a couple of weeks ago. I think the stock was 323. It's about $15. So you pay $15. So you are happy if that stock goes up by 15 or down by 15 or more, and that's when you'll make money. So you're straddling. It's like you're on the fence. You don't care which way it goes as long as it goes a lot in one direction or the other.
So the premium on both the call and the put is about $15.
Yeah.
Okay.
So it's about a 5% implied move on the earnings today. So we'll see.
Okay. Coming up, we'll get you Chris Tom's top options trading ideas. First idea, sell March 44 buck cash-covered puts on TMX Group.
Yeah, so this stock has been under a lot of pressure. You know, you've got, they have a lot of different business lines, okay? And many of them, they are either the biggest player or the only player in Canada. But a lot of what they do is selling data, right? Everything comes out. People have to pay for those quote systems. And I guess the market seems to be thinking that, look, you know, with AI and just different programs, there's either going to be ways around what they're producing, or a lot of their customers will have lower headcounts and will just need less of what they are selling. That, you know, the pricing is quite high. As someone who uses the product, sometimes I think I wish it was a bit lower.
It's a huge profit source for them. Yeah.
Very good. Yeah. So we think a lot of that's overblown. I don't think the banks are going to just cut their headcounts by 50% or anything like that. And I think anything, you know, they'll be able to offset that with increases. So stock is really close to its 52-week low, 45 and change, and we're going to keep it pretty tight and not sell a huge premium here. Sell the March $44 put for 55 cents. That's 1.25%. Annualized, that's around 13-14%. And so this is something that we'll be looking to do again and again. And if it goes down, then we'll be buying it at sort of mid-2024 prices, and happy to own it there.
You're happy in this case to own it at $44.
Yeah, and I think if we get put there, I think if we fast forward a year, 2 years, it'll be higher.
Cleveland-Cliffs, U.S. steel company, investors didn't love the numbers from them this week. So sell cash-covered puts, March price, $11 strike price. You're happy owning this at 11?
Yeah, if you look at a chart on this over the last, don't look over the last 10 years. It's been a disaster. The last year or so, it's pretty flat. So anyone who's just long this stock hasn't really done that great. But if you have been selling puts on it, you're doing well. These are very expensive puts. Stock's around $12.50. We're selling these $11 puts out 37 days and collecting 42 cents. So it's almost 4% with all that downside protection, about 16% in total. This is something that we use to kind of boost overall premium. You know, you sell puts on stuff that doesn't pay a lot, like Fortis, and then you balance that out with something like Cleveland-Cliffs. And, you know, we think that in the grand scheme of steel and U.S. auto production, they're going to be a big winner here.
And then finally, Synovus. That stock has been doing fairly well lately. You would be selling calls here, priced at $31, and March is the expiry.
Yeah, this has been one. We've been selling puts over and over and over in the low 20s. Now here we are in the high 20s. You sell that March $31 call. You get 55 cents. That's almost 2%. And if you're called away on that, that's the highest price this thing's seen in well over a decade. So happy to exit there, buy back later.
Chris, thank you very much indeed. We're out of time on Know Your Options. Chris Tom will be back in 2 weeks on February 28th.